Before we begin, please remember that I am not a financial advisor, mortgage broker, or certified financial planner. This video is for educational and informational purposes only. The information presented here is not intended as a substitute for professional financial advice. Buying a home is one of the biggest financial decisions you will ever make, and you should always consult with a qualified professional, like a licensed mortgage loan officer and a financial advisor, to discuss your specific situation before making any decisions. All examples are illustrative. Your results will vary. You open the app. Your heart pounds just a little bit faster. You know you shouldn't look, but you have to. And there it is. That number. That 3-digit number that feels more like a judgment than a measurement. 590, 610, maybe even lower. And in that single moment, a dream collapses. The dream of a front door you can call your own. The dream of a backyard for the kids or the dog. The dream of painting a wall whatever color you want without asking a landlord for permission. It all just evaporates, replaced by a single crushing thought. It's impossible. I'll be a renter forever. If that sounds familiar, if you have ever felt that gut punch, then I need you to listen to me very, very closely for the next few minutes. Because you have been told a lie. It's a lie whispered by big banks, shouted by sensational headlines, and even reinforced by well-meaning friends and family. The lie is that your credit score is a life sentence. The lie is that the door to homeownership is locked, bolted, and barricaded if you don't have a 720, a 740, or some other magical perfect score. Today we are going to burn that lie to the ground. The answer to the question, is it possible to get a home loan with a low credit score in America? Is not just yes. It's yes, and here is the exact playbook on how to do it. This isn't a video about wishful thinking. This is a video about strategy. We're not going to talk about vague tips like, pay your bills on time. You already know that. We're going to talk about the system itself. We're going to pull back the curtain and show you the specific government-backed loan programs, the hidden rules, and the little-known loopholes that lenders use every single day to get people with scores in the low 600s, and even the 500s into a home of their own. Let me tell you about a guy named Mark. Mark was a mechanic, great with his hands, worked incredibly hard, but his financial past was messy. A medical collection from an emergency surgery, a few late payments on a credit card from when he was laid off a couple of years back. His score was sitting at a 585. He'd walked into his local big-name bank, the one he'd used his whole life, and was practically laughed out of the office. The loan officer didn't even look up from his computer, just said, "Come back when you're at a 640, maybe a 660. Mark left feeling completely defeated, thinking that was the end of the story. But that wasn't the end, because Mark didn't understand the game. He thought all lenders were the same, all rules were the same. What he didn't know is that the loan officer he talked to was playing by a completely different, and much stricter set of rules than he had to. 6 months after that rejection, Mark closed on his first house. A 3-bedroom ranch with a 2-car garage for him to work on his project car. Same job, same income, and a credit score that had barely moved. So what changed? He found the right information, the right loan, and the right lender. And that's what I'm going to give you today. To do this, you first have to understand the fundamental secret of the mortgage world. It's a concept called overlays. This word is the key that unlocks everything. See, in the United States, most of the mortgage market is supported by the government. They create programs with specific rules to encourage homeownership. The most famous one is the FHA loan, from the Federal Housing Administration. The FHA sets the absolute minimum baseline requirements for a loan. They say, okay, to get an FHA loan, a borrower needs to meet these minimum standards. Now here's the secret. The FHA's actual, written-in-stone minimum credit score is 500. Yes, you heard me right. 500. With a 10% down payment, the FHA guidelines say a borrower with a 500 credit score can be approved. If your score is 580 or higher, the FHA guidelines say you can be approved with as little as 3.5% down. So you're probably screaming at your screen right now. Then why did my bank tell me I needed a 640? The answer is overlays. An overlay is an extra rule, a stricter guideline that a private lender, like a bank or a credit union, adds on top of the government's minimum rules. The government says the minimum is 580 for low down payment. A big bank might say, that's too risky for us. Our minimum is 640. They are literally overlaying their own rules on top of the government's. Why do they do this? Risk. Pure and simple. They want to minimize their risk of you defaulting. They want the cleanest, easiest, most profitable loans. They aren't breaking any laws. They're just running their business conservatively. The problem is they don't tell you this. They don't say, well, the FHA would probably be fine with your 610 score, but we aren't. They just say, sorry, you don't qualify. And you walk away thinking that's the final word for everyone everywhere. You think the FHA rejected you, when in reality it was just that one specific bank's internal policy. This is the single most important concept you need to grasp. Getting a mortgage with a low credit score isn't about changing the fundamental rules of the universe. It's about finding a lender that doesn't use as many restrictive overlays. It's about finding a lender whose business model is to work with the government's actual minimum guidelines. These lenders exist. They are out there funding loans for people with 620, 600, 580, and even lower scores every single day. You just don't hear about them because they don't have multi-billion-dollar advertising budgets or a branch on every street corner. So, our journey in this video is twofold. First, we need to arm you with the knowledge of what the real rules are. We are going to dive deep into the main government-backed programs: FHA loans, VA loans for our veterans and service members, and USDA loans for rural areas. We'll break down the actual non-negotiable credit score requirements for each. We'll talk about what they look for besides the score, things called compensating factors that can turn a no into a yes. Things like having steady job history, saving up a little extra cash for reserves, or having low monthly debt payments. These are the tiebreakers. Second, I'm going to show you how to find the lenders who play by these real rules, how to look for mortgage brokers or direct lenders who specialize in these types of loans, and what questions to ask them to know if they're the right fit for you. This is your masterclass in second chance homeownership. We're going to replace that feeling of dread when you see your credit score with a feeling of empowerment, because that number does not define you, and it certainly does not have to lock you out of your future. It's just one piece of data. And once you understand the whole puzzle, you can make that data work for you, not against you. Forget everything the big banks told you. Forget the scary articles you read online. Let's start from scratch right here, right now with the truth. The first thing we need to do is smash the biggest myth of all. The myth of the 620 credit score. Where did this number come from? And why is it the gatekeeper that stops so many people in their tracks? The answer is simpler and frankly more ridiculous than you think. Let's break it down. So that 620 number, it's not a law of physics. It wasn't handed down on stone tablets. It comes from two companies you've probably heard of, but might not fully understand: Fannie Mae and Freddie Mac. Think of Fannie and Freddie as the two titans holding up the American mortgage market. They don't lend money directly to you. Instead, they buy mortgages from the banks and lenders who do. This is a huge deal. By buying up all these loans, they free up the bank's money so they can turn around and lend to the next person in line. Keeps the whole system flowing. But because they are buying all this risk, they get to set the rules. They create the playbook that most of the country's lenders follow for what's called a conventional loan. And in that playbook, they decided that a 620 FICO score was, generally speaking, their minimum level of acceptable risk. It's their line in the sand. It tells them a borrower has a reasonable history of paying their bills on time. So when you walk into a big bank and they tell you, sorry, you need a 620, what they're really saying is, sorry, you don't meet the minimum requirement for us to be able to sell your loan to Fannie Mae or Freddie Mac. For them, it's a simple black and white filter. It makes their job easy. If you don't fit in that perfect little box, you're out. Now, here is the first secret that most people never learn. Even that 620 number isn't the whole story. Many banks, especially the big national ones, add their own rules on top of Fannie and Freddie's rules. This is called a lender overlay. Imagine the federal minimum wage is $7.25 an hour. That's the absolute floor set by the government. But California can come in and say, nope, here the minimum is $16 an hour. That's an overlay. They've added a stricter rule on top of the base rule. Banks do the exact same thing with credit scores. Fannie Mae might say 620 is the floor. But Big Bank of America might say, you know what, we're a little nervous. We don't want to take any chances. For us, the minimum is 640, or 660, or even 680. They are completely allowed to do this. This is why you can get rejected by 3 different banks for the exact same reason. Even if your credit score is technically above the 620 minimum. You're not crazy. You're just running into lender overlays. You're playing a game where every stadium has slightly different rules, and nobody bothers to tell you what they are until you've already lost. This system is designed for the convenience of the lender, not the reality of your life. It filters out anyone with a story. It filters out the person who had a medical emergency, the person who went through a tough divorce, the person who lost a job during the pandemic and fell behind. The algorithm just sees a number below their overlay and says, denied. But what if I told you that the entire game you've been forced to play, the conventional loan game with its 620 score and its lender overlays, is only one game? What if there's another stadium right next door with a completely different set of rules? A set of rules designed not for the banks but for you. There is. And it's called the FHA loan. FHA stands for the Federal Housing Administration. This isn't a bank. It's a government agency created way back in the 1930s during the Great Depression for one simple reason: to help regular Americans become homeowners when the banks wouldn't. The FHA doesn't lend you money. Instead, they do something much more powerful. They insure your loan. They go to the lender and say, hey, we know this person's credit isn't perfect. We know they might look like a risk, but we believe in them. So you go ahead and give them the loan. And if for some reason they can't pay it back, we, the US government, will cover your losses. Suddenly, the bank's risk plummets. They're no longer afraid of your credit score because they have a safety net. This insurance is the key that unlocks a completely different door to homeownership. And behind that door, the credit score requirements are radically different. Are you ready for this? The FHA's official minimum credit score to qualify for their flagship low down payment program is not 620. It's not 600. It's 580. Let me say that again. With a 580 credit score, the FHA guidelines say you can be approved for a home loan with only a 3.5% down payment. That's a game changer. That number, 580, suddenly puts the dream of owning a home back on the table for millions of people who were told it was impossible. But it gets even better. What if your score is below 580? Are you out? No. The FHA says that you can still get a home loan with a credit score as low as 500. 500. Now there's a catch. If your score is between 500 and 579, you have to put more money down. You'll need a 10% down payment instead of 3.5%. But the point is, the door isn't closed. Path still exists. A 520, a 550, a 575. These scores are not an automatic death sentence in the world of FHA loans. So now the big question is, if this is possible, why doesn't everyone know about it? Why did your bank tell you no when you had a 590 score? It goes back to those lender overlays. Some lenders, even when they're offering FHA loans, will still add their own, higher credit score minimums. They might say, yes, we do FHA, but our minimum is 620. They're still too conservative, too lazy, or too focused on only the easiest, most profitable loans to bother with someone who needs a little more work. The secret isn't just knowing that FHA loans exist. The secret is finding the right lender. You need to find a mortgage broker or a lender who specializes in FHA loans and is willing to work with the FHA's actual, true minimums. They are out there. They are the ones who believe in the mission of the FHA, to help people who don't fit the perfect mold. Of course, there's no such thing as a free lunch. The FHA program has its own costs. That insurance that they provide to the lender, you're the one who pays for it. It's called Mortgage Insurance Premium, or MIP. It's an extra fee added to your monthly mortgage payment. And unlike with conventional loans on most FHA loans, that MIP stays for the entire life of the loan. Some people see this as a deal breaker. They say, I don't want to pay extra every month. But think about what it really is. That monthly MIP payment isn't a penalty. It's the price of admission. It's the ticket that gets you into the game when you would otherwise be locked out. It allows you to start building equity, to stop paying rent, and to have a place to call your own years before you could if you waited to get a perfect 740 credit score. You can always refinance into a conventional loan later, once your credit improves and you have enough equity, and get rid of that mortgage insurance. But the FHA loan is your way in. It's the foothold. Think of it like this. A young couple, let's call them Mark and Jessica, were paying $2,000 a month in rent. They had saved up $15,000 for a down payment. But Mark had some old collections from college, and his credit score was a 585. They went to their credit union, the place they banked for a decade. The loan officer looked at the number, shook his head, and said they needed a 640 minimum. They were crushed. They figured they were stuck renting for another 3 or 4 years, trying to fix Mark's credit while home prices and rents just kept going up. Then a friend told them to talk to a mortgage broker who specialized in FHA. The broker didn't even flinch at the 585 score. He said, "No problem. Let's look at your income, your debt, your job history." He saw that they had a stable income and had been paying their rent and car payments on time for 2 years straight. He looked at the whole picture, not just the one number. 2 months later, Mark and Jessica closed on their first house. Their mortgage payment, even with the taxes, insurance, and that FHA mortgage insurance premium, was $2,100 a month. For just $100 more than they were paying in rent, they were now building their own wealth. That MIP wasn't a punishment. It was their ticket to freedom. The FHA loan fundamentally changes the question. The question is no longer, "Is my credit score good enough?" The question becomes, "Can I demonstrate that I am willing and able to pay my mortgage?" But the FHA isn't the only alternative. What if you're a veteran? Or what if you want to buy a home in a rural area? The government has created other powerful loan programs specifically for you, with rules that might surprise you even more. And what happens if your file is really complicated? What if a computer algorithm will never understand your story? There's a little-known process called manual underwriting, where a real human being can look at your file and give you the green light. That's where things get really interesting. So let's talk about this computer, this algorithm. It's called an automated underwriting system, or AUS. Think of it like a bouncer at the most exclusive club in the world, and that club is homeownership. The bouncer doesn't care that you're a good person. He doesn't care that you had a medical emergency that tanked your score, or that you lost your job during the pandemic and fell behind. He has one list, a checklist. Is your credit score above this number? Check. Is your debt-to-income ratio below this number? Check. If you don't tick every single box perfectly, the velvet rope doesn't move. You're not getting in. End of story. Millions of good, hard-working people get turned away by this digital bouncer every single year. But manual underwriting, this is like finding the club manager. The manager can walk out, look past the scuff on your shoes, listen to your story and say, "You know what? I get it. Come on in." A manual underwriter is a real live human being, a trained financial professional, whose entire job is to look beyond the numbers and see the person. They don't just see a 595 credit score. They're trained to ask why the score is 595. And if you have a good answer and you can prove it, that changes everything. The automated system sees a collection of late payments. The human underwriter sees a person who went through a messy divorce and had to support 2 households on one income for 6 months, but who is now back on their feet and has paid their rent on time, every single month, for the last 3 years. The algorithm sees a medical collection account for $7,000. The human sees the story behind it, an unexpected surgery, a fight with an insurance company, and more importantly, they see that you've saved up $10,000 in the bank since then. The computer sees risk. The human can see resilience. This is the entire game. You're not trying to trick a system. You're trying to tell your story to a person who is trained to listen. But they can't just take your word for it. They need proof. They need what the industry calls compensating factors. These are the powerful pieces of evidence that compensate for the low credit score. They are the reasons the underwriter can stamp "approved" on your file and sleep at night, knowing they made a good decision. So what are these magic compensating factors? Let's break them down because this is the playbook. First, and maybe the most powerful, is cash reserves. This isn't your down payment. This isn't the money for your closing costs. This is the money left in your bank account after you've paid for everything and gotten the keys to your house. The automated system might be happy if you have 2 months of mortgage payments in the bank. But for a manual underwrite, having 6, 9, or even 12 months of payments saved up is a massive signal of strength. Let's put that in real numbers. If your total mortgage payment, that's principal, interest, taxes, and insurance, is going to be, say, $2,000 a month, having an extra $12,000 sitting in your savings account is a giant flashing green light to an underwriter. It tells them that if you hit another rough patch, if you lose your job or your car breaks down, you won't miss a mortgage payment. You have a cushion. You are a lower risk. The second compensating factor is a low debt-to-income ratio, or DTI. This is simply the percentage of your gross monthly income that goes toward paying your debts, car loan, credit cards, student loans. Let's say you make $5,000 a month before taxes, and your total monthly debt payments are $2,500. Your DTI is 50%. That's high. The algorithm hates that. But what if your credit score is low, say 610, but your total monthly debt is only a $500 car payment? Now your DTI is only 10%. A human underwriter sees that and thinks, okay, their credit history is rocky, but they aren't drowning in debt. They have plenty of room in their budget to handle this new mortgage payment. A low DTI proves you're not living beyond your means, which directly counters the story a low credit score tries to tell. Third is a stable work history. This one is huge. Have you been at the same job for 2 years or more? Or at least in the same line of work? This demonstrates stability. It shows the underwriter that your income isn't a fluke. It's reliable and predictable. If you've been a nurse for 5 years, but you switched hospitals 6 months ago for a higher paying job, that's great. That's stable. But if you were a truck driver, then a retail manager, then you started a dog walking business all in the last 2 years, that's viewed as unstable. The underwriter needs to feel confident that the income you're using to qualify for this loan will continue for the foreseeable future. 2 years in the same field is the gold standard. Fourth, a larger down payment. For an FHA loan, the minimum down payment with a credit score under 580 is 10%. But even if your score is above 580, where the minimum is 3.5%, putting down more money voluntarily is a major compensating factor. Putting down 5% or 7% or 10% when you don't have to shows two things. First, it shows you have the financial discipline to save a significant amount of money. Second, it means you have more skin in the game. You have more of your own money invested in the property, which makes you far less likely to ever walk away and let it go into foreclosure. You have more to lose, and that makes you a safer bet. Finally, there's the story itself. The most critical piece of the manual underwriting puzzle is your letter of explanation, or LOX. This is your one chance to speak directly to the underwriter in your own words. This is where you connect the dots for them. This letter cannot be a list of excuses or a sob story. It must be a factual, mature, and responsible explanation of what happened, why it happened, and what you've done to make sure it will never happen again. The structure is simple and powerful. Acknowledge the problem, explain the circumstances, and describe the resolution. For example, Dear Underwriter, I am writing to explain the late payments on my credit report from the spring of 2022. During that time, my son was hospitalized with a severe illness, which required me to take an unpaid leave of absence from work. This temporary loss of income caused us to fall behind on several bills. However, since returning to work full-time in July of 2022, I have brought all accounts current, and as you can see from my payment history over the last 24 months, I have not had a single late payment. To prevent this from happening in the future, we have also built up a 6-month emergency fund, which is reflected in our asset statements. Do you see the difference? You're not blaming anyone. You are taking ownership. You are presenting a short-term problem with a long-term solution. You are showing them that you are not your credit score. You are the responsible person who learned from a difficult situation. A well-written letter of explanation, combined with strong compensating factors like cash reserves and low debt, can overcome almost any credit blemish. It transforms your application from a list of negative data points into a compelling story of human resilience. So you've got your story straight, you've gathered your documents, you've written a killer letter of explanation. But how do you find this mythical human underwriter? Because walking into a big national bank and asking for manual underwriting will likely get you a blank stare and a pamphlet. The person at the front desk probably doesn't even know what it is. You need to find the right kind of lender, the ones who have this process built into their DNA. So who are these lenders? Where do you find them? Well, first let's talk about where you won't find them. You won't find them at the massive skyscraper-sized banks you see on every street corner. Think about it. The big national banks, your Chases, your Wells Fargos, your Bank of Americas, they operate on a model of massive volume and razor-thin margins. They need to process thousands of applications a day, and the only way to do that is with automation. They are built around the automated underwriting system, that AUS we talked about. Their entire business model is designed to find the cleanest, easiest, most cookie-cutter loans possible, approve them in seconds, and move on to the next. Your file, with its lower credit score and its need for a human touch, is a wrench in their assembly line. Slows them down. It requires a salaried employee to spend hours, maybe even days, on a single file that their computer already told them was risky. It's just not profitable for them. And on top of that, these big banks have something called lender overlays. This is a critically important concept to understand. An overlay is an extra rule the bank adds on top of the government's minimum requirements. So the FHA might say, we will insure a loan for a borrower with a 580 credit score. That's the baseline, the federal rule. But a big bank might look at that and say, that's too risky for us. For our bank, we will only lend to FHA borrowers who have a 620 or a 640 credit score. That extra 40 or 60 points is their overlay. They are making the rules even stricter. Why? To reduce their risk and to make sure the loans they approve are almost guaranteed to perform perfectly. So when you go to a big bank with a 590 score, they don't say, "Sorry, the FHA won't approve you." They say, "Sorry, we can't approve you." It's a crucial distinction. You're not being rejected by the program. You're being rejected by that specific bank's internal policies. What about credit unions? They're a little better. They're member-owned, more community-focused, and sometimes they're more willing to look at the person behind the numbers. They can be a good option, and for some people they work out. But many credit unions, especially the larger ones, have adopted the same automated systems and risk-averse overlays as the big banks because it's efficient. It's a definite maybe, but not the silver bullet we're looking for. Then you have the big online, direct-to-consumer retail lenders, the ones that blanket the airwaves with commercials promising a fast, easy push-button mortgage. And they deliver on that promise for the right borrower. They have perfected the art of the high-speed, automated approval for people who fit perfectly inside the box. If you have an 800 credit score, 20% down, and a W-2 job you've been at for 10 years, they are fantastic. But if you have a 585 score, a recent job change, or some self-employment income, you are a square peg for their round hole. Their system is designed for speed and scale, not for nuance or storytelling. So, if it's not the big banks, probably not the credit unions, and not the big online guys, who is left? The answer, and the single most important piece of advice in this entire video, is to find a good mortgage broker. This is the secret. A mortgage broker is fundamentally different from a loan officer at a bank. A loan officer at Bank of America works for Bank of America. They have access to one set of loan products, one set of underwriting guidelines, and one set of overlays, Bank of America's. If you don't fit their specific narrow criteria, all they can do is wish you luck. A mortgage broker, on the other hand, works for you. They don't lend their own money. They are a professional matchmaker. They have established relationships with dozens, sometimes over 100 different wholesale lenders. These are lenders you've probably never heard of. They don't have fancy retail branches or Super Bowl commercials. All they do is work with brokers to fund loans. And here's why this is the game changer. Among those dozens of lenders, each one has its own little niche, its own appetite for risk. A good broker knows their lenders inside and out. They'll know that lender A is fantastic for veterans, but has a strict 620 minimum score. They'll know that lender B has the best rates on the market, but their underwriters are incredibly difficult. And they'll know that lender C and lender D over there, well, they specialize in FHA loans. They have no lender overlays on credit scores. They will happily accept the FHA minimum of 580. And even more importantly, they have a dedicated, robust department for manual underwriting. It's not some forgotten process. It's a core part of their business. They are built to listen to your story. When you go to a bank, you get one shot. When you go to a broker, you get 50. You fill out one application, they pull your credit one time, and they can then present your scenario to multiple lenders to find the one that is the perfect fit for your specific situation. They know how to package your loan file. They know how to write a compelling letter of explanation. They know who to call at the lender's office to talk through a tricky file. They are your advocate, your guide, and your fighter, all in one. Their entire job is to solve puzzles, and a low credit score file is just a puzzle waiting to be solved. Think of it like this. Imagine you need a very specific, rare prescription. You could walk into a giant chain pharmacy where the pharmacist is overworked, follows a rigid computer protocol, and if they don't have it on their shelf, they just say, "Sorry, we're out." Or you could go to a specialist, a compounding pharmacist who knows the formulas, who can call different suppliers, who can talk to your doctor, and who can create the exact medicine you need from the ground up. The mortgage broker is that specialist pharmacist. So how do you find one of these miracle workers? You have to be strategic. Don't just Google mortgage and click the first ad. You'll likely end up at a call center for a big retail lender. Instead, get specific. Search for mortgage broker in your city, or FHA loan specialist broker in your state. Even better, ask for a referral from a seasoned real estate agent. A good agent, especially one who works with a lot of first-time homebuyers, has a short list of brokers they trust. These are the brokers who have saved deals, who have gotten tough loans closed, who have performed miracles when the big bank said no. An agent's reputation depends on their ability to get their clients to the closing table, so they will guard the names of their best brokers like gold. Once you have a few names, you need to interview them. Yes, interview them. You are hiring them for a critical job. Get them on the phone and ask these questions. First, how many wholesale lenders do you work with? The answer should be more than 10 or 20. The more lenders they have, the more options you have. Second, and this is the most important question, do you have lenders in your network that will do a manual underwrite on an FHA loan for a borrower with a score under 620? If they hesitate, if they say, well, it's tough, or if they don't know what you're talking about, thank them for their time and move on. The right broker will say, absolutely. I have 2 or 3 that are my go-to for exactly that scenario. Third, what's the lowest credit score you've personally been able to get a loan closed for in the past year? This tells you if they have real-world experience with files like yours. Finally, ask them how they get paid. Typically, the broker's compensation is paid by the wholesale lender out of the loan proceeds, so there's no direct cost to you. But it's a professional question that shows you're a serious, educated consumer. Finding the right broker is the moment the game shifts from, is this possible? To, how do we make this happen? It's the moment you stop getting rejected by a faceless computer algorithm and start building a strategy with a human partner. It's the difference between despair and hope. Now that you know who to talk to, the next step is getting your story straight. We need to gather the evidence that proves to a human underwriter that you are more than just a 3-digit number. We need to build your case. This is where the game is won or lost. It's where you transform from a faceless application with a scary-looking credit score into a real 3-dimensional human being with a story of resilience. Think of yourself as a lawyer and the underwriter as the judge. Your credit report is the prosecution's opening statement, and it looks bad. But you, the defense attorney, haven't even had a chance to speak yet. This is that chance. We are going to build an airtight case for the defense piece by piece, document by document. The ammunition we're going to use is something the industry calls compensating factors. That's a fancy term for all the good things in your financial life that compensate for the bad stuff on your credit report. A low score tells a story of past trouble. Compensating factors tell the story of your present stability and your future promise. Our job is to make that second story so loud, so compelling, and so well documented that it drowns out the first one. The cornerstone of your entire case, the single most powerful document you will create, is your letter of explanation or LOX. This is your personal testimony to the underwriter. It's your opportunity to look them in the eye metaphorically and tell them what happened. A computer can't read this letter. An algorithm can't understand nuance, context, or a comeback story. But a human underwriter can. And that's who we're writing this for. A perfect letter of explanation has 3 parts. First, the acknowledgement. You start by taking ownership. No excuses, no blaming, just the facts. In 2020, I went through a difficult divorce that significantly impacted my finances, leading to several late payments and a collection account. Or, following an unexpected job loss during the pandemic, I was unable to keep up with my credit card payments. You state what happened clearly and concisely. You are not a victim. You are a narrator of past events. The second and most critical part is the action. This is where you detail the specific steps you took to fix the problem. This is where you show the underwriter that you didn't just let disaster happen to you. You fought back. To manage the situation, I sold my car to pay down the highest interest debt and created a strict written budget, which I have followed for the last 36 months. Or, I immediately enrolled in a state-sponsored career retraining program, found new employment within 6 months, and entered into a payment plan with the collection agency, which I have now successfully completed. You see the power in that? You're demonstrating problem-solving skills, responsibility, and grit. You're showing them you are a fighter. The final part is the resolution. This is where you bring it home, connecting your past actions to your present stability. As a result of these actions, I have had 0 late payments on any account for the past 24 consecutive months. My income has been stable and has increased by 15% in the last 2 years, and I have saved an additional $10,000 for emergencies, separate from my down payment. This is the closing argument. You've acknowledged the past, detailed your fight in the present, and painted a picture of a secure future. A well-written LOX, one that is honest, accountable, and detailed, can single-handedly turn a denial into an approval. But a story, even a great one, is just a story. To make it undeniable, you need evidence. Every single claim you make in that letter needs to be backed up by a document. We're building your evidence locker. The most powerful piece of evidence you can provide is proof of a stable housing payment history. This is your ace in the hole. If you've been renting, you need to prove you've paid that rent on time every single time for at least the last 12 and ideally 24 months. Why? Because it's a direct comparison. If you can prove you've paid $2,000 a month in rent without fail to your landlord, it's a very powerful argument that you can pay a $2,000 a month mortgage to the bank. You can prove this with canceled checks, bank statements showing the automatic withdrawal, or by having your landlord fill out a form called a verification of rent, or a VOR. This single factor can sometimes outweigh a dozen old mistakes on a credit report. Next, we establish rock-solid job stability. The standard application asks for 2 years of W-2s. We're going to go further. Have you been at the same company for 5 years? 10 years? Get a letter from your Human Resources Department verifying your employment history. This shows loyalty and stability, qualities lenders adore. Have you gotten promotions or raises? Document them. Provide the offer letters or pay stubs that show your income progression. We're not just showing them where you are. We're showing them your upward trajectory. Then we demonstrate that you are not living on the financial edge. This is done by showing cash reserves. After you've accounted for your down payment and your closing costs, how much money do you have left over in savings? Lenders want to see a safety net. The gold standard is having at least 3 to 6 months of your future total mortgage payment, that's principal, interest, taxes, and insurance or PITI, sitting in your savings account. This tells the underwriter that if you hit a bump in the road, like a car repair or a small medical bill, you won't immediately default on your mortgage. It proves you're a responsible planner, not just a hopeful homebuyer. We also need to demystify your bank statements. For the last 60 to 90 days, every single large deposit that isn't from your regular paycheck needs a source. Did your uncle give you $5,000 for your down payment? That's a gift, and you need a signed gift letter from him stating that the money is a gift and not a loan that needs to be repaid. Did you sell your motorcycle for $3,000? You need the bill of sale and a copy of the deposited check. Unexplained cash appearing in your account is one of the biggest red flags for underwriters. It's not because they think you're shady. It's because federal anti-money laundering laws require them to source all funds. By preparing this documentation ahead of time, you show them you're organized, transparent, and have nothing to hide. Finally, we can build a case for your responsibility using what's called alternative credit. Do you have a perfect payment history on things that don't typically show up on your credit report? Think about your cell phone bill, your utility bills, your car insurance. Gather 12 months of statements for these accounts. When an underwriter sees a credit report with late payments on credit cards, but you can provide a stack of documents showing you have never, ever been late on your light bill or your phone bill, it helps paint a more complete picture. It tells them that when it comes to the essential services of life, you are reliable. When you take your powerful, honest letter of explanation and staple it to a thick file of meticulously organized evidence, proof of rent, proof of job stability, proof of savings, source deposits, and alternative credit, you are no longer just an application. You are a portfolio, a case study in financial recovery. You've anticipated every question, addressed every concern, and provided proof for every claim. You've taken control of the narrative. You've built an undeniable case that you are a responsible, recovering borrower who is ready for the long-term commitment of homeownership. Now, with this powerful dossier in hand, it's time to match your story to the right tool. Because not all home loans are created equal, and some are specifically designed for a story just like yours. We need to find your golden ticket. Let's start with the most famous golden ticket of all, the workhorse of the low-credit mortgage world. You've probably heard its name whispered in online forums or mentioned by that one friend who bought a house when everyone else said it was impossible. We're talking about the FHA loan. FHA stands for the Federal Housing Administration, an agency born from the ashes of the Great Depression. Its original mission way back in 1934 was to get the American housing market moving again, to give regular people a fighting chance at owning a piece of their country. And that mission is still beating strong today. Here's the secret sauce. The FHA doesn't actually lend you the money. A bank, a credit union, a mortgage lender, they're the ones cutting the check. The FHA's job is to ensure that loan. They step in and say to the lender, "Hey, we know this borrower's credit history isn't perfect. We know they might look like a risk on paper, but we believe in them. And to prove it, if they default on this loan, we'll cover your losses." Suddenly, the entire equation changes. The lender's risk plummets. And when their risk goes down, their willingness to say yes to someone like you goes way, way up. The FHA loan is the ultimate cosigner. It's the government vouching for you. So what does it take to get this powerhouse on your side? This is where it gets good. For an FHA loan, the credit score requirement is stunningly low. If your FICO score is 580 or higher, you can qualify for their flagship program. A loan with only a 3.5% down payment. Let's put that in perspective. On a $300,000 home, a conventional loan might demand 20% down. That's $60,000 in cash. For most people, that's an insurmountable mountain. But with an FHA loan, a 3.5% down payment is just $10,500. Still a lot of money, but it's a hill, not Mount Everest. It's achievable. It's within reach. Now, what if your score is even lower? What if you're in that 500 to 579 range? The FHA doesn't shut the door on you. It's a tougher climb for sure. You'll be required to put down 10% instead of 3.5%. But the door is still open. Path still exists. That number, 500, is a floor that few other loan programs would ever dare to touch. This all sounds incredible, right? A government-backed loan with a tiny down payment and a credit score requirement that acknowledges real life happens. So what's the catch? There's always a catch, right? In this case, it's not so much a catch as it is the price of admission. It's called mortgage insurance premium, or MIP. Remember how the FHA insures the loan for the lender? Well, MIP is how you, the borrower, pay for that insurance policy. Comes in two parts. First, there's an upfront mortgage insurance premium. It's a one-time fee, currently 1.75% of the loan amount. Most people don't pay this out of pocket. They roll it right into their mortgage. So, on that $300,000 home, your actual loan amount becomes a little higher. The second part is the annual MIP, which is paid in monthly installments as part of your mortgage payment. It's an extra $100 or couple $100 a month, depending on your loan size and down payment. And here's the single most important thing you need to understand about FHA MIP. For most borrowers, anyone who puts down less than 10%, you pay it for the entire life of the loan. It doesn't go away after a few years. It's your constant companion. Some people see this and they panic. They call it a penalty. But that's the wrong way to look at it. MIP isn't a punishment for having a low credit score. It's the key that unlocks the door. It's the fee you pay that allows you to start building equity now, instead of waiting 5 years on the sidelines trying to perfect your credit and save a massive down payment, all while home prices and rents continue to rise around you. It's the cost of getting into the game. Okay, so that's the FHA loan. The accessible, powerful, and most common tool in the shed. But what if you're part of a very specific group of Americans? What if you've worn the uniform of this country? Then we're not just talking about a golden ticket. We're talking about the hero's reward. We're talking about the VA loan. Guaranteed by the U.S. Department of Veterans Affairs, this is without a doubt the most powerful mortgage product on the planet. And it's reserved for active duty service members, veterans, and eligible surviving spouses. If you fall into one of these categories, listen very closely. Benefit number 1, and it's the showstopper: 0 down payment. That's not a typo. You can buy a home with absolutely nothing down. That $10,500 we needed for the FHA loan, you can keep it for moving expenses, for furniture, for an emergency fund. This single benefit has made homeownership a reality for millions of veterans who would have otherwise been locked out. Benefit number 2. The VA itself does not set a minimum credit score. Let me repeat that. The Department of Veterans Affairs does not have a credit score floor. Now, just like with the FHA, private lenders will have their own internal minimums, often called overlays. Many will look for a score of 620 or so, but they have far more flexibility. This is where your dossier, your story of financial recovery, becomes your superpower. A lender might see a 610 score but also see your stable income, your low debt, and your letter of explanation, and because the VA is backing them, they can make a common-sense decision and approve you. Benefit number 3. No monthly mortgage insurance. That MIP we just talked about with the FHA loan, it doesn't exist on a VA loan. This can save you hundreds of dollars every single month, and tens, if not hundreds of thousands of dollars over the life of the loan. Instead, there's a one-time VA funding fee. It varies depending on your service, down payment, and whether it's your first time using the benefit. But this fee can also be rolled into the loan amount, and many veterans with service-connected disabilities are completely exempt from paying it at all. The VA loan isn't a handout. It's a benefit that was earned through profound sacrifice and service. If you are eligible, it is the first, second, and third door you should be knocking on. Now for our third and final golden ticket. This one is the best kept secret in the mortgage industry. It's for anyone who dreams of a little more space, a backyard, a life outside the concrete jungle. This is the USDA loan. That stands for the United States Department of Agriculture. And I know what you're thinking. I'm not a farmer. You don't have to be. The USDA's mission is to support the health and prosperity of rural America. And one way they do that is by making it easier for regular families to buy homes in less populated areas. How do they do it? With a loan that looks remarkably like the VA loan but for civilians. First, the USDA loan also offers a zero down payment option. Again, this is a massive barrier to homeownership completely removed. Second, it has some of the most flexible credit guidelines out there. Like the VA, the USDA doesn't have a hard and fast minimum score, though lenders will. But they are known for being more forgiving, especially if you have that well-documented story of financial stability. And the mortgage insurance on a USDA loan is significantly cheaper than the FHA's MIP. It's a win-win-win. So what are the requirements? Two big ones. First, geography. The property you're buying must be in a USDA-eligible area. And you will be shocked at what counts as rural. We're not just talking about farmland. We're talking about small towns and suburbs across the entire country, many just a short drive from major cities. 97% of the landmass in the United States is in a USDA-eligible zone. Second, income. Your household income can't be too high. This program is specifically designed to help low to moderate income families, so there are limits that vary by county and family size. The FHA, the VA, and the USDA. These are not subprime predatory loans. These are government-backed, strategic programs designed to help hardworking Americans build wealth and stability through homeownership. They are your golden tickets. One of them likely has your name on it. Your dossier, your proof of income, your saved-up cash, your story of resilience, is the key. These loan programs are the locks. Now you know which doors to try. The final piece of the puzzle is finding the right person, the right kind of lender, who knows how to use these keys and isn't afraid of a story that's a little more interesting than most. So, who is this magical person? This key master? It's not a specific person, but a specific type of person. Finding the right lender is more important than finding the right loan program, because the right lender will find the program for you. This is the step where most people with bruised credit fail. They walk into the wrong office, get a cold, hard no, and assume that's the end of the story. They assume the no is about them when in reality it was about the place they went for help. Let's break down the players in this game because you have to know who you're talking to. Think of it like this: you wouldn't go to a steakhouse and ask for sushi. They might both serve food, but they have different kitchens, different ingredients, and different chefs. The mortgage world is exactly the same. First, you have the Goliaths, the big banks, the names you see on every street corner and on every commercial: Chase, Bank of America, Wells Fargo. It's the most common first stop for people. You probably have a checking account with one of them. It feels comfortable, familiar. And that is precisely the trap. These massive institutions are built on volume and efficiency. They are giant automated assembly lines. Their business model is to process thousands of perfect, cookie-cutter applications every single day. They want a W-2 employee with an 800 credit score, 20% down, and a debt-to-income ratio so low it's practically a rounding error. That's their filet mignon. When you walk in with a 590 credit score, a past bankruptcy, and a story to tell, you are throwing a wrench into their billion-dollar machine. The person you talk to, the loan officer, is often just an employee following a very, very strict rule book. They plug your numbers into a computer, and the computer says no. They don't have the authority, the incentive, or often even the knowledge to fight for you. Worse yet, these big banks have something called investor overlays. This is a critical concept to understand. An overlay is an extra rule the bank adds on top of the government's rules. So while the FHA says, "We will insure a loan down to a 580 credit score," a big bank might say, "That's nice, but we won't lend to anyone with a score below 640. They are taking the government's already flexible guidelines and making them stricter to reduce their own risk. It's their right to do so, but it means you could be perfectly qualified for an FHA loan by the government standards and still get rejected because you didn't meet the bank's secret, internal-only rules. Going to a big bank first is like starting a video game on the hardest difficulty setting. It's possible to win, but why would you? Next, we have the local champions. Credit unions and community banks. These are a completely different animal. They are not beholden to Wall Street shareholders. They are owned by their members. Their primary mission isn't to maximize profit, it's to serve their community. This fundamentally changes the conversation. When you sit down at a credit union, you're more likely to be seen as a person, a neighbor, not just a FICO score. They still have rules, of course, but they often have more flexibility and a greater willingness to engage in what's called manual underwriting. This is the holy grail for someone with a complex financial story. Instead of a computer making a black and white decision in 3 seconds, a human being, an underwriter, will actually read your file. They will read the letter you wrote explaining why you had a medical collection or a period of unemployment. They look at the whole picture. They can look at your strong rental history, your consistent savings, and your stable job and see the human being behind the numbers. They have the power to make exceptions. They can sometimes ignore the overlays that the big banks live and die by. They are the local restaurant where the chef knows your name and is willing to cook something special for you that's not on the menu. The downside is that their menu might be smaller. They may not offer every type of loan, and you do have to be a member, though the requirements are often very easy to meet. Now let's talk about the secret weapon, the master guide for this journey. I'm talking about a good, independent mortgage broker. This is, in my opinion, the single greatest advantage a borrower with a low credit score can have. A mortgage broker is not a lender. They do not work for a bank. They work for you. Think of them as a professional matchmaker for money. A broker has access to the wholesale lending market. They have relationships with dozens, sometimes hundreds of different lenders, big banks, community banks, credit unions, and specialized lenders you've never even heard of. They are not tied to a single set of rules. Their job is to know the intricate, specific, and constantly changing guidelines of every lender in their network. So when you tell your story to a mortgage broker, they're not thinking, does this fit into my bank's tiny little box? They're thinking, okay, a 595 score, a Chapter 13 bankruptcy discharge 2 years ago, and a high debt ratio. I know Lender A won't touch this and Lender B's overlays will kill it. But Lender C down in Texas specializes in post-bankruptcy FHA loans, and they don't care about medical collections. Let's send it to them. They do the shopping for you. They know which doors are unlocked. Instead of you getting 10 rejections and giving up, you have a professional who submits your application to the 1 or 2 places that are most likely to say yes. They know the underwriters at these wholesale lenders. They can pick up the phone and advocate for you, explaining the context of your situation before the file even gets looked at. Their incentive is aligned with yours. They only get paid if your loan closes. They are your champion, your translator, and your strategist all in one. Finding a great mortgage broker is like hiring an expert guide to navigate a treacherous jungle, while going to a big bank is like wandering into that same jungle with nothing but a tourist map. Then there's the digital frontier. The big online lenders. The Rockets, the Better.coms. Their appeal is obvious. Speed, convenience, a slick app. And for that perfect cookie-cutter borrower, they can be fantastic. But for those of us with a story, they often suffer from the same problems as the big banks, just with a prettier user interface. They are volume machines. Their process is heavily automated. When your application hits a snag, you can find yourself in a customer service labyrinth, talking to a different person in a call center every time you call, re-explaining your situation over and over to someone who doesn't have the power to do anything but read from a script. Getting a human to manually underwrite or truly understand your file can be a massive challenge. Finally, a word of warning about a group you might encounter in your search: hard money lenders. You might see ads that say no credit check, bad credit okay, fast cash, run. These are not traditional mortgage lenders. They are private investors who provide short-term, high-interest loans, usually to real estate flippers. They don't care about your credit because they're not lending on your ability to repay. They're lending on the raw value of the property. If you default, they are more than happy to foreclose and take the house. The interest rates can be astronomical. We're talking 12, 15, even 18%, plus thousands in upfront fees. This is not a path to homeownership. It is a debt trap, pure and simple. So the landscape is clear. You have the rigid Goliaths, the compassionate local champions, and the expert guides. While a great credit union is a fantastic option, your first call, your first search, should be for a highly rated, experienced independent mortgage broker in your state. Ask them point blank, do you have experience working with clients with credit scores under 620? Which lenders in your network are best for FHA loans with lower credit? Their answer will tell you everything you need to know. Finding this person, this broker, is like finding the general who will lead your army into battle. But even the best general needs an army that's prepared, equipped, and ready to fight. Once you have your guide, your job is to give them the ammunition they need to win the war for you. And that means crafting your story and your application into a weapon that no underwriter can defeat. So let's talk about that ammunition. This isn't just about gathering pay stubs and bank statements. Anyone can do that. This is about forging a narrative. You see, an underwriter looks at a low credit score and they don't see a person. They see a number, a risk, probability of default. Your job, with the help of your loan officer, is to force them to see the human behind the number. You have to tell the story that your credit report can't. And your primary weapon to do this is one of the most underutilized and misunderstood tools in the entire mortgage process: the letter of explanation, or LOX, as it's known in the industry. A letter of explanation is exactly what it sounds like. It is a formal letter you write that explains in detail every single derogatory mark on your credit report, every late payment, every collection, every charge-off. I know what you're thinking. Why would I want to draw attention to my mistakes? Because you're not drawing attention. You are seizing control of the narrative. You are preemptively answering the questions the underwriter is already asking in their head. Without your letter, a 60-day late payment on a car loan just looks like irresponsibility. With your letter, that same late payment becomes a temporary struggle during a company-wide layoff from which you have now fully recovered. See the difference? One is a red flag. The other is a story of resilience. Do not treat this letter as a chore. This is your closing argument to the jury. It needs to be precise, honest, and powerful. And there is a formula to writing a perfect, undeniable letter of explanation. Every explanation for every negative item should have 4 parts: acknowledge, explain, resolve, and prevent. First, acknowledge. You state the issue head-on. No excuses, no beating around the bush. Regarding the collection account from Verizon for $150, dated June 2021, you are showing the underwriter that you are not hiding from your past. You are owning it. Second, explain. This is the why. What happened? This is where your story comes in. But keep it concise and factual. This isn't a diary entry. It's a statement of facts. At the time, I was transitioning between jobs and there was a 2-month gap in my income. This unexpected loss of cash flow led to me falling behind on this bill. Or, this medical collection was the result of an emergency room visit for my child. There was a dispute with my insurance company over the coverage, which has since been clarified. Be specific. A vague "I had some financial problems" is useless. A specific "I was furloughed for 3 months during the pandemic" is a verifiable, understandable reason. Third, resolve. This is the how. What did you do about it? This demonstrates accountability. I have since paid the collection account in full, and a receipt is attached. Or, I entered into a payment plan with the creditor and have made 6 consecutive on-time payments, as shown in the attached statement. This tells the underwriter that when you made a mistake, you took steps to fix it. This is a massive indicator of future behavior. And fourth, the most important part, prevent. Why will this never ever happen again? This is your promise of future stability. Since securing my current position 2 years ago, I have built an emergency fund equal to 6 months of my living expenses to ensure that a temporary loss of income will never again affect my ability to meet my obligations. Or, I have since changed insurance providers and now have a comprehensive family health plan, as well as a dedicated health savings account to cover any future out-of-pocket medical costs. Let's put it all together. Imagine you had a late payment on a credit card 2 years ago. A bad letter says, "I was late on my credit card, sorry about that." A killer letter says, "Regarding the 30-day late payment reported by Capital One in July of 2022, acknowledge. At the time, I was dealing with a significant and unexpected car repair that cost $2,000, which temporarily depleted my savings. Explain. I paid the full amount due, including the late fee, the following month, and have maintained a perfect payment history with all creditors since that time. Resolve. To ensure this never happens again, I have since established a separate sinking fund specifically for auto maintenance and have increased my primary emergency savings by 30%. Prevent. Who would you rather lend 30 years of money to? The person who said sorry, or the person who just demonstrated that they are a strategic, responsible, forward-thinking adult who learns from their mistakes? You do this for every single negative item. It is tedious. It is painstaking. But it transforms your application from a pile of risky numbers into a portfolio of a comeback story. But the letter is just the beginning of your ammunition. It's your sword, but you also need a shield. This shield is built from what the industry calls compensating factors. These are the overwhelmingly positive things in your financial life that help offset the risk of a low credit score. The underwriter is literally looking for these. Your job is to make them so obvious, so powerful, that they can't be ignored. The first and most powerful compensating factor is stability, specifically job stability. If you've been at the same job for 2 years or more, that is gold. If you've been in the same line of work, say you're a nurse and you switched hospitals for a better paying job for 2 years or more, that's also gold. It tells the lender that your income isn't a fluke. It's stable, it's predictable, and it's likely to continue. An underwriter will take a borrower with a 590 credit score and a 3-year job history over a borrower with a 650 score who has had 4 different jobs in the last year, every single time. The second compensating factor is your cash reserves. This is your secret weapon. After you pay your down payment and all your closing costs, how much money do you have left in the bank? The bare minimum is not the goal here. The goal is to show the lender that you are not living on the edge. If you have 3, 6, or even 12 months worth of your future mortgage payment, we're talking principal, interest, taxes, and insurance, left in savings, you become an incredibly attractive borrower. You are demonstrating that if life throws you a curveball, if you lose your job or face another emergency, you can still make your mortgage payments. You are single-handedly lowering the bank's risk. And in this game, lowering their risk is the only thing that matters. The third compensating factor is your debt-to-income ratio, or DTI. We've touched on this before, but it's critical to see it as part of this fortress you're building. A low credit score signals past risk. A low DTI signals current financial discipline. Before you even apply, you should have spent months aggressively paying down credit cards, car loans, and personal loans. Getting your total monthly debt payments, including your future mortgage, to be under 40 or 43% of your gross monthly income is a massive compensating factor. It proves that your budget can easily handle the new mortgage payment without being stretched to the breaking point. Finally, there's the down payment. While an FHA loan might only require 3.5% down, coming to the table with more is a huge statement. A 5% or 10% down payment shows you have skin in the game. You have more to lose, which makes you less likely to walk away. It also reduces the loan-to-value ratio, which is another metric the bank uses to measure risk. Think of it from the underwriter's perspective. Their job is to say no. Their entire training is focused on identifying risk and killing the deal. You are not trying to convince them to like you. You are trying to build such an ironclad, logical case for your own financial recovery and stability that a no would be an illogical decision. So when they pull up your file, they see the 585 score. That's the first impression. But then they see your letter of explanation, a masterfully written narrative of recovery. They see a 2-year job history. They see 6 months of mortgage payments in a savings account. They see a low DTI ratio and a 5% down payment. Suddenly, the 585 score isn't the whole story. It's just the prologue. The rest of the application is the real story. A story about a low-risk, responsible person who hit a rough patch and has since built a financial fortress. You've given the underwriter all the ammunition they need to justify approving your loan. You've made it easy for them to say yes. Now you have your guide, the right loan officer. And you've assembled your weapon, a bulletproof application package. You're ready for battle. But you can't just walk onto any battlefield. Taking this perfect application to the wrong lender is like bringing a sword to a gunfight. You'll lose every time. The final piece of the puzzle is knowing exactly where to go, which doors to knock on, and which lenders are specifically set up to say yes to a story like yours. And just as importantly, how to spot the predatory lenders who are waiting in the shadows to trap you. So let's pull back the curtain. The world of mortgage lending isn't one monolithic entity. It's a diverse ecosystem with different players, each with their own rulebook. Your job isn't to change your story to fit their rules. It's to find the lender whose rulebook was written for a story just like yours. First, let's talk about the government-backed giants. These are the programs you've likely heard of: FHA, VA, and USDA loans. They aren't lenders themselves, they're insurers. Think of them as a rich, powerful co-signer who tells the bank, "Hey, if this person can't pay, I've got your back." This insurance dramatically reduces the lender's risk, which is why they're willing to be so much more flexible on credit scores. The FHA loan is the undisputed champion for first-time homebuyers and those with bruised credit. The Federal Housing Administration allows for credit scores as low as 580 with just a 3.5% down payment. In some cases, you can even get approved with a score as low as 500, but you'll need to bring a 10% down payment. The magic of the FHA is that this flexibility is baked into its DNA. Lenders who offer FHA loans are specifically equipped to look beyond just the 3-digit number and consider your whole financial picture. They're used to seeing applications that aren't perfect, and they have clear guidelines for how to approve them. Next up, for our service members, veterans, and eligible surviving spouses, the VA loan is, without a doubt, the most powerful mortgage product on the market. The Department of Veterans Affairs guarantees a portion of the loan, which allows most lenders to offer them with zero, let me repeat that, zero down payment. And here's the kicker. There's often no minimum credit score required by the VA itself. Now, individual lenders will have their own minimums, what they call overlays, but they are often far more lenient than for conventional loans, frequently starting in the low 600s or even high 500s. On top of that, VA loans have no private mortgage insurance or PMI, which can save you hundreds of dollars every single month. If you are eligible for this benefit, you absolutely must explore it. It is a benefit you have earned through your service. And then there's the hidden gem, the USDA loan. The U.S. Department of Agriculture program is designed to promote homeownership in rural and suburban areas. If you're not trying to buy in the middle of a major city, you need to check your eligibility. Similar to the VA loan, it offers a zero down payment option. And like the FHA and VA, the government guarantee means lenders can be much more forgiving on credit. The income limits and geographic restrictions mean it's not for everyone. But for those who qualify, it's an incredible pathway to owning a home with very little cash out of pocket. Now, beyond the big government programs, there's a world of lenders that most people overlook. They walk right past them on their way to the giant faceless national banks. I'm talking about your local community banks and credit unions. Think about it. When you walk into a massive multi-billion-dollar bank, you are a number. Your application is fed into a computer, and an algorithm spits out a yes or no. There's no room for nuance, no space for your story. But when you walk into a local credit union or a community bank, you're a person. You're a member of their community. They have a vested interest in the local economy and the people who live there. Many of these smaller institutions do something called portfolio lending. This is a golden term you need to know. A portfolio loan means the bank is not selling your mortgage off to Wall Street. They are keeping it in-house, on their own books. And because they're the ones holding the risk and the reward, they get to set their own rules. They aren't bound by the rigid, one-size-fits-all guidelines of Fannie Mae and Freddie Mac that govern most conventional loans. This gives them incredible flexibility. The loan officer might be able to sit down with the underwriting committee and actually plead your case, explaining the context behind your credit history and highlighting your strengths, like your stable job or your significant savings. They can make common-sense decisions that a computer algorithm simply can't. But what if your situation is even more unique? What if you're self-employed with fluctuating income, or you had a major credit event like a bankruptcy or foreclosure just a couple of years ago? This is where you enter the world of non-QM lenders. QM stands for Qualified Mortgage, which is a set of rules created after the 2008 financial crisis to ensure loans are safe and affordable. Non-QM simply means the loan doesn't fit neatly into that perfect, government-defined box. This is not the subprime lending of the past. These are legitimate, regulated loans for legitimate, hardworking people whose financial lives just don't look standard on paper. Non-QM lenders are specialists. They've built their entire business model around understanding complex situations. For example, they offer bank statement loans for entrepreneurs. Instead of looking at your tax returns, which might be full of write-offs, they'll analyze 12 or 24 months of your business bank statements to determine your true cash flow. They have programs for real estate investors. They have programs for people 1 or 2 years out of a bankruptcy. They understand that life happens. A medical emergency, a divorce, a failed business. These events can tank your credit, but they don't define your ability to pay a mortgage today. A non-QM lender is the one you go to when you need someone to read the whole book, not just the cover. You'll likely face a higher interest rate and may need a larger down payment, but they represent a powerful yes, in a world that might only be telling you no. Finding these lenders, the FHA specialists, the local credit unions, the non-QM brokers, is the key. But just as important is knowing how to spot the sharks circling in the water. Predatory lenders thrive on desperation. They target people with low credit scores because they know you feel like you're out of options. You must be able to recognize their tactics from a mile away. Here are the giant flashing red flags. First, extreme pressure. If a lender says, "This incredible offer is only good for 24 hours, you have to sign now," run. That's a classic tactic to prevent you from shopping around or reading the fine print. A legitimate offer will be there tomorrow. Second, vague or hidden fees. If you ask about the total closing costs and they give you a fuzzy answer like, "Oh, we'll figure that out later," or they can't provide a clear itemized loan estimate form, that's a major warning sign. They might be planning to load your loan with thousands in junk fees at the last minute when they know you're too committed to back out. Third, the bait and switch. They'll promise you an unbelievably low interest rate to get you hooked, and then right before closing, suddenly there's a problem, and your rate is now 2 points higher. Some fluctuation is normal, but a massive unexplained jump is a hallmark of a predator. Fourth, and this is critical, they try to steer you into a loan that's clearly wrong for you. Maybe it's an interest-only loan with a massive balloon payment you'll never be able to afford, or a variable rate mortgage with a dangerously low teaser rate that's set to explode. They push these products because they make the lender more money, not because they're good for you. And finally, the most blatant red flag of all. They ask you to sign blank documents or lie on your application. If anyone ever tells you, "Just sign here, we'll fill in the details," or, "Let's just say you make a little more money, no one will check," you are not dealing with a loan officer. You are dealing with a criminal. Navigating this world requires a healthy dose of skepticism and the courage to walk away from a bad deal. Remember, you are the prize. You are the customer. You hold the power. Knowing where to look and what to avoid is half the battle. You now have a map to the lenders who are actually designed to help you. But once you're sitting across the desk from them, or filling out that online form, a new challenge begins. The final piece of this entire puzzle is how you present your case. It's about how you assemble your documents, how you write your letters of explanation, and how you structure your finances in the months leading up to your application to create an undeniable story of a comeback. You found the right audience. Now you have to deliver the performance of a lifetime. And there is one critical document, one piece of your story that, if you get it wrong, can single-handedly destroy your chances, even with the perfect lender. That document is the letter of explanation, or as it's known in the industry, the LOX. And it's not just a letter. It's a closing argument. It's your final appeal to the judge and jury, the underwriter. For a borrower with a pristine 800 credit score, the application is a simple math problem. For you, the application is a story. And the letter of explanation is the one page where you get to control the narrative. Get it wrong, and you confirm every fear the underwriter has. You sound like a risk. You sound like a liability. You sound like the person your credit report says you are. A bad letter is vague. It says things like, "I had some financial difficulties a few years ago." That tells the underwriter nothing. It's a red flag for someone who is hiding details. A bad letter deflects blame. "My ex-spouse ran up the credit cards." While that may be true, the underwriter sees an account with your name on it and a failure to manage your own obligations. A bad letter is emotional without being factual. "It was a really hard time for me and my family." The underwriter might sympathize, but they can't approve a loan based on sympathy. They need cold, hard evidence that you are a good risk today. So how do you write the letter that tips the scales in your favor? How do you write the letter that turns a maybe into a clear to close? You follow a simple 4-part structure: acknowledgement, context, resolution, and future. First, acknowledgement. You must take radical ownership of the past. You start the letter by directly and unemotionally addressing the negative items. No excuses, no justifications, just the facts. For example, to the underwriter, this letter is to explain the series of late payments on my credit card accounts from June 2021 to December 2021, and the collection account from ABC Medical. That's it. You've immediately shown the underwriter that you're not hiding from your past. You're confronting it head-on. This builds immediate trust. You're not making them hunt for the problems. You're serving them up and preparing to explain them. Second, context. This is where you tell the story. But it's not a sob story. It's a factual account of an event, not an excuse. This is the most important part. You need to connect the negative credit items to a specific temporary life event that is now over. The key words there are specific and temporary. For instance, in May of 2021, I experienced a sudden job loss due to company-wide downsizing. During the following 7 months of unemployment, my primary focus was on maintaining housing and providing for my family with limited savings. This led to the aforementioned late payments, as I prioritized essential needs over unsecured debt. Do you see the difference? You're not saying, "I had a hard time." You're providing a clear, logical reason for the financial hardship. You lost your job. You had to make tough choices. You chose to feed your family. What human being, including an underwriter, can't understand that? You're explaining the why behind the numbers. Maybe it was a medical emergency, a divorce, a business failure. Whatever it was, state it clearly, link it directly to the credit issues, and most importantly, show that the event has concluded. Third, resolution. This is where you pivot from the past to the present. You've explained what happened. Now you must prove that you fixed it. This is your comeback story in a paragraph. You need to show the specific, tangible steps you took to recover financially and correct your course. This is where your recent on-time payment history, which we've talked about, becomes your star witness. You would continue the letter like this. In January 2022, I secured a new stable position in my field with a higher salary. Immediately upon reemployment, I contacted my creditors to arrange payment plans, which have since been paid in full. As you can see from my credit report, for the past 24 consecutive months, every single one of my financial obligations has been paid on time, without exception. Furthermore, I have successfully built an emergency fund equivalent to 6 months of living expenses. This is pure gold to an underwriter. You're not just saying, "I'm better now." You're providing a receipt. You're showing them the evidence. New job, paid off debts, perfect payment history for 2 years, and an emergency fund. You have demonstrated with action, not just words, that you are no longer the same person who was in that temporary crisis. You've built a financial fortress. And finally, the fourth part, the future. This is your promise. It's a short, confident closing statement that reassures the underwriter that the past will not repeat itself. You tie it all together. The financial controls, budgeting system, and emergency savings I now have in place ensure that I am well prepared to handle any future unforeseen circumstances without jeopardizing my financial obligations. I am confident in my ability to manage the responsibilities of this mortgage and am eager to take the next step in securing a stable home for my family. You've acknowledged the past, explained the context, demonstrated the resolution, and guaranteed the future. You've taken the underwriter on a journey from a point of high risk to a point of profound stability. You've transformed from a liability on a spreadsheet into a resilient, responsible human being who overcame adversity. That is a story a lender can bet on. This entire process, from fixing your mindset to fixing your finances to finding the right lender and telling your story, is a marathon. It's a testament to your character. Let's just quickly recap the mountain you've learned to climb. You started by changing the way you see yourself. You are not a bad credit borrower. You are a comeback story in the making, and your past does not define your future. You learned to read a credit report not as a judgment, but as a roadmap, focusing all your energy on the last 24 months to prove you are a new and improved risk. You got inside the mind of the underwriter, understanding their one true fear, the fear of default, and learned to structure your entire application around calming that single fear. You understood that compensating factors are your secret weapons. A bigger down payment, stable job history, and cash reserves aren't just numbers. They are powerful arguments in your favor. You discovered that the big banks are not your arena. Your champions are the local mortgage brokers, the credit unions, the community lenders who are trained to look beyond the score and see the person. And now, you know how to craft the single most important document in your arsenal. The letter of explanation. The story that ties it all together and makes your case undeniable. Getting a home loan with a low credit score in America is not a myth. It is not a lottery. It is a strategic campaign. It's for the determined. It's for the people who refuse to let a number dictate their destiny. The journey is harder, yes. It requires more work, more documentation, more resilience. But the feeling of holding those keys, knowing you earned them not because your path was easy, but precisely because it was hard, that feeling is something no one can ever take from you. You have overcome the financial storm that put you here. You have already done the hardest part. This right here, this is just the final chapter. The keys to your future home aren't just made of metal. They're forged in that resilience. They represent the stability you fought for, the security you built from the ashes of a crisis. Go out there and tell your story. Assemble your team, present your case, and claim the home you deserve. If this journey we've been on has given you even a shred of hope or a single piece of actionable advice, do me a favor and hit that like button. Subscribe for more real-world financial strategy that respects your struggle and celebrates your strength. And share this video with just one person who needs to hear that their dream of owning a home is not dead. Finally, in the comments below, I want you to write 3 words. I am ready. Because after everything you've learned and everything you've overcome, you absolutely are.